And then you have billionaires and centimillionaires, very wealthy people who load up on debt, who invest in very risky things, and they're actually unhappy because of the level of stress their financial life brings them. It's really all about how you structure your financial life, how you structure your affairs.
All right, so it's a birthday podcast for me today, and I have someone I've been looking forward to chatting with for quite some time, Jared Dillian. Jared is a very interesting guy who I think, unlike a lot of people in finance, has lived a pretty diverse life, and his writings and commentary, I think, echo that diverse life. A little bit about Jared. He is the editor of the Daily Dirtnap, a leading and somewhat contrarian newsletter that's been in publication now for almost 20 years. He's also a best-selling author, recently releasing his latest book, No Worries: How to Live a Stress-Free Financial Life. I think a book most of us will appreciate in these volatile economic and geopolitical times. But why do I say Jared is an interesting guy? Aside from his writing, which has a very unique tone to it, he has an MBA, served in the U.S. Coast Guard, loves to DJ for fun, worked at Lehman Brothers up until the Great Recession, is a very successful investor, is a libertarian who I think has opted not to vote now for almost 2 decades. And he's the creator of the awesome portfolio concept, which we'll get into that. But first, Jared, welcome to the pod.
Hey, thanks for having me.
Let's do things a bit different on this pod. I think we should talk about your new book right away. Not as a plug so much, but as the perfect starting point for the convo. You know, many investors, I think, don't really know what to do these days. It's very hard to hide anywhere with capital. Inflation is confusing a lot of investment theses. Valuations are historically high, particularly among large caps. There are geopolitical threats to economies and nations. It's hard to navigate this environment, and I bet most of us who are managing our own money would love a stress-free portfolio and financial life. But as I said, it's hard to figure out how to navigate these waters currently. So why don't you tell me why you wrote the book No Worries? I think the title's awesome. And, from your 35 years in the business, in the financial markets, what stresses people out most about their finances today, would you say?
There's 2 sources of financial stress, and one of them is debt and the other is risk. That is it. There's no other sources of financial stress. I kind of headed this question off in the book because I knew what people were going to say to me. A lot of people are like, well, what if you just don't have enough money? Isn't that a source of financial stress? And I'm like, actually, not necessarily. Like, I know lots of people who don't make a lot of money. They're debt free. They don't invest. They don't have any risk in the capital markets. They're perfectly happy. And then you have billionaires and centimillionaires, very wealthy people who load up on debt, who invest in very risky things, and they're actually unhappy because of the level of stress their financial life brings them. So you can be rich and have a lot of financial stress. You can be poor and have none. It's really not a function of how much money you have. It's really all about how you structure your financial life, how you structure your affairs.
Let's say I'm a guy, I'm making $100,000 a year. I've got 2 kids. My wife, perhaps she works, let's say the household income's $150,000 a year. To me, I think about that and I say, it's unfortunate, but a household in that scenario seems like it would be stressful. It'd be hard to get by, relatively speaking. I think, with the inflation, grocery prices, mortgages, you got cars and this and that. How do you, I guess what I'm trying to say is if you're not someone with abundance, how is it not stressful in this current environment with inflation and the cost of living the way it is?
Well, I will say that inflation is that, look, I wrote the book, most of it, I wrote about 2/3 of the book in 2021, before inflation really took off. I think if I had written it today, I might even have a whole chapter on inflation and how that affects people. but I just didn't work out that way. Wages have gone up, but they have not gone up as fast as prices. Okay, so wages have gone up pretty significantly, but not as fast as inflation, and that has created some stress for people. And the main reason people are experiencing stress from inflation today is because of food prices. Okay, and food prices are up 46% since the pandemic, right? So almost 50%. But that doesn't really capture the whole picture, right? Really what it is in 2019, food prices represented 6.5% of the average household budget. Today, it's 11.3%, okay? So really that extra 5% is coming out of vacations, it's coming out of travel, it's coming out of savings, it's coming out of investment, and it's crowded out a lot of other things that people want just to get something that they need, okay? So, the prices of everything have gone up, but I would say it's really food that has made the big difference, especially for people in lower incomes, like I said, when that's 11.3% of your budget and it used to be almost nothing, like that's a big difference.
Austerity, right? It's not easy. Cutting all the expenses, cutting the little pleasures in life, right? I know you don't preach that in the book, but that is the natural reaction on somebody who's seen their food prices go up 46% in 4 years or whatever, is to cut other things. You mentioned, vacations and so forth, but how do you navigate that with a household budget? Like, would your first choice be to cut the small things or remove the big ticket items?
I would actually go behind door number 3. And there's a chapter in the book called The Revenue Side. And basically what I talk about in that chapter is that you can have a lot more impact on your financial situation from earning more revenue than cutting expenses. Okay. So for somebody who makes $60,000 a year, which is the average income in the US, you make $60,000 a year, there's really kind of a limit as to how much you can cut in the way of expenses. Mm-hmm. You might be able to cut out some expensive food. You might be able to cut out some clothes. You might, whatever. You might be able to scratch up $3,000 a year. But if you got a second job and you were working an additional 20 hours a week, you might be able to make an additional 20 or 25,000 a year. So you go from making 60,000 to 80 or 85,000, and that's a much bigger impact than trying to cut expenses, right? So one of the things I talk about in the book, you mentioned abundance, is really getting this abundance mentality and to get away from thinking that money is scarce. Because money is actually not scarce. Money is plentiful. It's abundant, right? I mean, we print it all the time. Okay, so there's lots of money out there. So this is what I do personally in my own personal life. I am constantly looking for ways to make more money, and not just within the newsletter. I mean, even in the newsletter, I'm a marketing machine. I'm always trying to get people to buy subscriptions, but I have other business ventures too. I invest in startups. I'm actually starting another company right now. I do a bunch of things. I write books. I mean, even the books make some money. So I'm always doing things to increase the revenue side rather than cut the expense side.
When you say increasing the revenue side, I know you're passionate about writing. I mean, you've got, I think, 5 books now, even one in fiction. Would you suggest that, for people or households to generate extra income, they pursue something they're passionate about, or just focus on getting revenue any which way you can?
Well, ideally, you can do both at the same time. I met this woman years ago. This is like 7 or 8 years ago. I met this woman. She was friends with a subscriber, and she came to Myrtle Beach, and she wanted to meet with me. She was a young woman, and she had a business selling stuff on Etsy. And basically what she does is she sells like sea glass, like earrings and knickknacks and stuff like that. It's all sea glass. She has a decent business on Etsy, selling this stuff. I don't know what she makes. I would say about 6 figures, maybe more. And she's doing what she loves, and she's entrepreneurial, and she's hardworking, and she's made a business out of it. and there's lots of examples of that. I think people really get to a place where they're stuck. They have a job, they're making 60,000 a year, and they say, well, I make what I make, and that's really it. And the irony of that is they come home from work at 4:30 and they sit on the couch and watch TV for 6 hours, right? Well, in those 6 hours, there's a lot of things you could be doing, to make money. We all have a lot more free time, available time than we think we do.
I think you're absolutely right. A lot of it does come down to time management. People, we live in this culture where, it's people like to say that they're busy. But then if you actually kind of deconstruct the day for somebody, there's 4 or 5 hours in every day where people have some time to do something, right?
Absolutely.
So sticking on the topic of passion, but jumping around a bit, I know you're passionate about the capital markets. You had a successful career trading as a trader for Lehman Brothers. You were there during the Great Recession. I've always wondered, why wasn't Lehman bailed out? I've always wondered about that. Why do you think that was?
Oh, I know exactly why. So there's two reasons. The first reason is a lot of Lehman's assets were very illiquid, which is another way of saying that Lehman had bought about $40 billion worth of physical real estate all over the world. Desert in California, condos in Scotland, apartment buildings. Their real estate group had bought about $40 billion worth of stuff, and it was stuff that was going to take 10 years to liquidate, right? So if the government had bailed out Lehman, it would have been a huge mess selling off all these illiquid assets, right? That's number one. Number two, people on Wall Street personally disliked Dick Fuld, okay? So if you go back to 1998, when long-term capital management blew up, long-term capital was bailed out, but not by the government, by Wall Street. It was a private sector bailout. And basically all the banks agreed to chip in like $40 million to bail out long-term capital. And Dick Fuld refused to do it. He did not want to be associated with that. He refused to do it. And that created some resentment among the other bank CEOs. So when it came time to bail out Lehman, they said, too bad, you didn't help us out 10 years ago. So
interesting. What was your experience? Positive, negative, neutral? How was it? What did you take away from it?
Well, first of all, it was positive, but it wasn't all positive. There were great people there, super bright people, hardworking, entrepreneurial. I still have a lot of friends that I keep in touch with. Nice. Really, I mean, Lehman had some of the best people. The culture, like, it's kind of hard to describe. Like, you would say it's entrepreneurial, but it's actually beyond that. If you had an idea of a way to make money, you could just do it. You didn't need to ask permission. There was no bureaucracy. You could just you basically do whatever you wanted. And if it worked out, then you were a hero. And if it didn't work out, fine. Like, it was fine.
Wow.
So it was that kind of place. The reason I say it was negative is just because my job, trading ETFs, was the most stressful job on Wall Street. Like,
really?
It was by the time 2008 came around, like, I was really, really, really burned out. You see the gray hair, like, that's where it comes from. Like,
you got good flow though. You got good flow, so you haven't lost it. Was there any sort of work-life balance?
So I'll tell you a story about that. Lehman did not keep track of your vacation days. Okay. So if you wanted to take off 3 months, they would let you take off 3 months. But really what they cared about was how much money you were making, right? So if you were not profitable and you were taking off 3 months, then you would get fired, right? But if you were bringing in $100 million, you could take off as much time as you want. Nobody was going to bother you about it. In the 7 years that I worked there, I took 9 days off total in 7 years.
Jeez.
So part of that was I love working there. Part of that was if I wasn't there, the money wasn't making itself, so I had to be there. Basically, in 2007, I took a 1 week vacation. That was 5 days. And then over the other 6 years, I took 4 other days off.
Let's get into the US and its raging debt levels, because I think this is a huge challenge and confusion, even for me and a lot of our viewers, is how do we navigate, how do we invest when we have a reckless US government? And this isn't from a fiscal point of view, and this isn't a bash on Democrats or Republicans. The country hasn't had a surplus in 25 years, so it's both parties. But to a guy like me, it appears the country's finances are going to hell. Am I wrong, and can it be fixed? I don't see, no matter who wins, Trump or Biden, I don't see any of them really changing the trajectory of the debt. I think the last surplus in America, again, was 25 years ago, so I don't think this is party specific. Trump ran deficits too. What do you see going forward with the U.S. debt situation, and how can what's the best approach from a portfolio standpoint for an average investor like myself and our viewers?
I can tell you the way to fix it, but nobody's going to do it. Like, you basically need to cut the size of the federal government in half and run. You don't even need to run a surplus. If you run a deficit of 2% of GDP and we're growing at 3 or 4%, like, we'll grow our way out of the deficit over time. The problem is that debt to GDP is now about 120, 130%, which is almost, but not quite, past the point of no return. Yeah. So we're to the point now. Look, like 4 years ago, interest payments were about $300 billion a year. Now they're $1.1 trillion, right?
Yeah.
So it's almost checkmate. But let's just say, for example, somebody like Rand Paul became president and dramatically reduced the size of government while keeping taxes constant, then you could get out of the problem. So you were talking about how to invest in this environment. Basically, if it is checkmate and our debt is going to grow out of control into the future, then there is a possibility that interest rates will go up, and the Federal Reserve will have to cap interest rates by buying an unlimited amount of bonds, which is called monetizing the debt. Yeah. And that's when inflation goes bananas. We have 20, 30, 40% inflation. So really, in this environment, you should be looking at things that give you exposure to inflation. So gold, real estate, to a lesser extent, stocks do well in inflationary environments, stuff like that. Like, also, earlier we talked about debt being a source of financial stress. Well, in an inflationary environment, you actually want to have debt because your income will go up, and in nominal terms, and those payments will get smaller, relatively speaking. So, it's funny. Like, I'm talking to you from a new house. I moved into this house a month ago. It's a gigantic house. I have a huge amount of debt, and that was a calculated decision based on the fact that we're probably going to have inflation for the foreseeable future.
And I agree. I think it's here for years. I think it's here to stay. From an allocation perspective, you talk a lot about hard assets. What is a stress-free portfolio? Where do we put our money if the American government continues to spend more than they take in? Won't it lead to the mother of all crises? So that would say, okay, gold, sure, real estate, sure, but wouldn't equities be out? Wouldn't that be a concern if we hit kind of the point of no return, as you talked about fiscally? Wouldn't that be a concern to own equities?
Actually, no. You would be surprised. Like, if you look at episodes of high inflation or hyperinflation in other countries in history, stocks have generally done a decent job of keeping up with inflation, right? So stocks are nominal assets. They're not real assets. They're nominal assets. So stocks are a decent place to be. The worst place to be is bonds. Like, really, like,
right.
You would want to have a lower allocation to bonds in that environment.
My stress is that there's going to be a financial crisis. You're more in the camp that there's going to be prolonged inflation. Maybe it gets severe, but there's not going to be let's call it like a Great Recession or heaven forbid, a depression. You don't see that coming down the pipe?
No, I mean, a recession or a depression is a deflationary episode, which, look, like, anything's possible. Like, I'm not ruling that out. But most likely what we're going to have is another inflationary episode, and it could be soon.
Yeah.
Stan Druckenmiller was saying that if Trump got elected, he thought CPI would be at 6% in a year, that Trump would be very inflationary, and Biden's very inflationary as well. If the Democrats run the table and we have a Democratic president in Congress and they can pass whatever legislation we want, that deficit to GDP is going to go from like 8% to 16%. We're going to be running $4 trillion deficits. That will happen, which is super inflationary. So really the way I look at it is that regardless, pretty much every outcome of the election is inflationary.
That would kind of mimic what happened in the 70s too. So we do have kind of historical reference for that. Now, you said recently that 40%, I think it was, of your net worth is in gold at the moment. Obviously, you're concerned about inflation, as we just discussed. But I mean, that's absolutely massive. I'm a gold bug, but why such a large allocation?
I don't think it's massive. I mean, people have 80% allocations to stocks.
True.
And 60% allocations to stocks. What? It's so weird about gold because
true.
People are like, they're like, I have a little bit of exposure to gold. I have like 2%. I'm like 2%, like that.
Yeah. That's low. That's low.
So, look, like in the awesome portfolio, which is in the book, I basically say that the ideal asset allocation is 20% stocks, 20% bonds, 20% gold, 20% cash, and 20% real estate. Mm-hmm. Me personally, I have like 40% gold and 0% bonds at the moment. Okay.
Right.
But aside from that, I'm following the awesome portfolio to the letter. So the thing about gold is that it's not correlated to anything else. And if it is correlated, those correlations are unstable. So sometimes it's correlated to stocks, sometimes it's correlated to bonds, sometimes, it kind of depends, but it varies over time. And because of that, gold is the best risk reduction vehicle in history. When you take gold and add it to a portfolio, it automatically brings the volatility of the portfolio down. Okay. And volatility is the enemy. So that's why it's the ultimate diversifier. So a lot of people say, well, you have 40% gold, you must think that gold is going up a lot. Not necessarily. It's really just a good diversifier, and it makes my portfolio a lot more stable, right? I mean, yes, I am bullish on it, but that's not the only reason I own it.
So China, the Central Bank of China recently reported that, after 18 consecutive months, they didn't purchase any gold. Gold dropped sharply on the news. What's your take on that? Does it matter? Are they lying? Is there anything to that? Or is it just they didn't buy any gold last month and it's not a big deal?
I think they may be taking a break. They may not. I think they're lying. I think China has a lot more gold to buy. I think they're trying to talk down the price. They've done this with other commodities. They've done it with copper. They've done it with oil. So
yep.
I think they're trying to talk down the price a little bit, and they were successful. The day that they announced that was a day that gold was down $60, So I think it was successful in the short term, but ultimately I want to say they have like 8% of their reserves in gold or 14% or something like that. I think they want to get it to 20% over time. That's where I think a lot of foreign central banks want to get their reserves to, is about 20% in gold. So I think they have a lot more to buy.
Why do they want to get it to 20%? Just as basically a substitute for the USD? Is that the simple strategy?
It is.
Is there more to it?
The reason they're doing that is because of what happened at the start of the Ukraine war when we placed sanctions on Russia and seized their dollar-based assets. If you have money in a bank or treasuries in a bank, if it's not domiciled within the country, the U.S. has the ability to seize it. And if you have gold within your own national borders, that is wealth that cannot be seized or confiscated. So that is the lesson that countries learned after Ukraine, is that, if you're worried about getting on the wrong side of the United States, which controls the world's financial system, then you want some gold reserves within your national borders.
Now, this is interesting. You always have a good take. I've heard you talk about this a lot, and I think you have one of the more balanced, level-headed takes. But I want our viewers to hear it. So, I'm a gold bug. Our audience is speculators and hard asset investors typically. Now, a lot of the commentators in the space are talking about doom and gloom. U.S. dollar's done. It's going to happen. 10, 15 years. It's not going to be the global reserve currency anymore. I don't think that's the case on the timeline. I do think that's the case, though, at some point here, probably in my lifetime. It's my birthday today. I'm 41 years old, so let's say I'm halfway through.
Happy birthday.
Hey, thanks, man. Let's say I'm halfway through this great adventure. I could see it happening in my lifetime that the USD is no longer the world's reserve currency. What are your do you have any thoughts on that?
The dollar will only lose its reserve currency status when we lose an aircraft carrier. That's when it'll happen. So the reserve currency concept is not based on economics. It's based on political power, right? The dollar is the world's reserve currency, not because we have the strongest economy, but because we have the strongest military, okay?
Yep.
And especially the strongest navy, right? The navy is how a country projects power overseas, right? So Britain used to have the world's biggest navy. They had the reserve currency, right? Before Britain, Spain had the world's biggest navy. They had the world's reserve currency, right? So if we lose a naval war, then the U.S. will lose its reserve currency status, right? That's when it will happen. And the interesting thing is that China now has a larger navy than the U.S. in terms of number of ships. They're
Really?
not. Oh yeah, by quite a bit actually. Yeah,
Wow.
almost twice as many. So
Wow.
they're not as sophisticated as U.S. ships, but they have more. And look, like that's really what it comes down to. When I was in the Coast Guard, the Navy had about 600 ships. Okay, now we have less than 300. This is like 25 years later. We have less than 300. This is not a positive development at all.
No.
Right?
No.
Like, and the cost to build an aircraft carrier is about $10 billion. We have 12 aircraft carriers, right? The cost to build a cruiser or destroyer is about $2 billion. Okay. So if I were president, I would cut the size of government, but I would make significant investments in the naval fleet, right, in order to increase the size of the fleet. I think it's absolutely necessary. We haven't really had a naval war since World War II, right? Vietnam was not a naval war. The Gulf War was not a naval war. We haven't had a naval war since the 1940s. And that is how you lose your world's reserve currency status.
So you would build up the Navy as a means to protect dollar hegemony.
Yeah, absolutely. Yeah.
That makes a lot of sense. I mean, there's always the memes online, the US dollar, it's a fiat currency backed by nothing. And then the next picture is, well, it's actually backed by a lot of hard assets. And there's pictures of, jets and helicopters and Army Rangers and so forth. So just going to hop around. I want to touch on two more things. You almost perfectly timed and called for gold's near-term top recently. I think you called it almost to the day. I think you said it would trickle back down to somewhere around 2250. You called it at around 2420 or something like that. Now, where do you see gold going from now till the end of the year? Like, what do you see from a price action perspective? Because a lot of the big banks, they're getting pretty bullish, or they were pretty bullish on their price predictions, like ranging from 2,500 to 3,000 before year end. What's your take?
Gold has an infinite capacity to disappoint. As a longtime gold investor, I've had it for 19 years. And gold is, for the last 19 years, actually since going back to 2000, gold has done very well. It's actually beaten the stock market. But the interesting thing about gold from a technical standpoint is that even though the returns have been great, in terms of time, gold spends much more time going down than it does going up. It goes up in spurts, right? Like just what we had from 2000 to 2400 that took about a month. And now we're going to have like a year of consolidation. It's really like 3 steps forward, 2 steps back. You know, this is very short term, but I'm not super crazy about the price action right here. I do think we could get back to about 2250. You know, over decades, over 10 years, 20 years, based on our discussions earlier about the debt situation, there's virtually no chance that it goes down on a 10-year basis, you know, 5 to 10-year basis.
Yeah, I definitely agree with that. On that point, kind of, you talked about technicals and price targets, and we touched on that. What actually drives your investment strategy? Is it like, how do you pick equities, for example? Is it technicals or fundamentals? Like, what drives you? How do you find your picks, your winners?
It's actually sentiment. It's based on the theory that the crowd is usually wrong, right? So for example, like Nvidia is, you know, going to be the biggest stock in the world. It's a bubble. Like we can just call it a bubble. It's trading at like 39 times revenues or something like that. Like it's a bubble. It will have a 75% drawdown, right? There's many historical examples of this. The biggest one is Cisco. Cisco in 2000, right? Like Cisco, you know, and the funny thing is that I even said this in my newsletter like 6 months ago. We were talking about the Magnificent Seven. And I said, this is what's going to happen. We're going to have the Magnificent Seven, then we're going to have the Magnificent Four, then we're going to have the Magnificent One, and it's going to be NVIDIA holding up the entire market. Because at the end of a bull market, breadth narrows over time until one stock is holding up the whole thing. And that's what Cisco did in March of 2000.
Right.
So really, if you can predict when NVIDIA is going to reverse, you can kind of predict when we're going to have a correction or a bear market. You know, I look at the chart, I focus on it every day. And, you know, I get anecdotes from people and I hear about, you know, I heard one today about, some teenager wanted to give this guy $200 to invest in NVIDIA. He was going to Venmo him $200 to buy NVIDIA. Grandma's buying it, you know, stuff like that. You know, one thing I've heard is that, you know, I've talked to financial advisors who have said that, you know, their clients hold it, but they're actually buying more because they feel like they don't own enough. Which is crazy if you think about a stock that's a $3 trillion market cap. Like, what's the potential upside? Anyway, that's kind of what I'm focused on right now. But in general, I focus on sentiment. I focus on how people feel about the market. Fundamentals, to me, look, I'm not going to say that my way is the only way, but I've never been able to be successful with fundamentals. You're looking at stale financial statements, the same stuff that everyone is looking at. Technicals I've been a little more successful with, but charts, everybody's looking at the same charts, you know, like it's very efficient. Sentiment is really where I have my edge, and that's what I base my whole career on.
And hence the contrarian approach too, I think. So that's so there's one other topic I want to touch on before we part ways here today. So this is the one thing that stresses me out about long-term investment planning, including, you know, real estate, hard assets, equities, bonds, whatever. The demographics, I mean, across the Western world are scary. You know, we've gone from, I think it was a fertility rate of near 4 50 years ago to now, you know, 1.4, 2.1 is the replacement level. If this fertility rate trend doesn't change, and there's no reason to believe it will, because these are very hard trends to reverse, isn't that a concern for hard asset investing? You know, we've talked about hard asset investing earlier in this pod. I look at the real estate portfolio or the allocation to gold, even maybe not so much gold, but certainly real estate, even retailers, like if you're buying retailers, as the demographics issue becomes more and more, like look at South Korea and Japan, doesn't that put pressure on asset values?
It sure does, but let me tell you something. We do not have demographic problems in the United States. The birth rates are falling, but we just let 10 million people into the country illegally. okay? And they're not going home. And they're going to get jobs, and they're going to rent apartments, and they're going to buy houses. We only build about a little less than 1 million new houses a year, right? And now we just let in 10 million people that in about 5 to 7 years are going to want to buy a house. Like, the real estate market in the United States over the next 10 years is going to go parabolic. It's absolutely
Really?
going to go parabolic. Yes. Yes. There's going to be a trickle up effect. The people that came in, they're going to rent cheap apartments, and they're going to have to build more multifamily units, and it's going to trickle up. It's going to trickle up to expensive houses. That is the one part of the immigration crisis that really nobody is talking about. Usually it's focused on jobs. It's very nativistic. People say, well, these foreigners are taking our jobs and stuff like that. But really what people should be focusing on is the real estate, because up until 2021, we had a big deficit. We had a big supply deficit of houses, going into the pandemic. And we've been building more in the last couple of years. But in order to account for the people that came in, we need to be building a lot more. And there's really the home building industry is just not capable of keeping up with population growth, right? So for sure, in Japan, Italy, Western Europe, they have the terrible demographics. And the funny thing is that the profession of economics is not prepared to deal with declining populations. Like, it just doesn't work. Like, the underlying assumption is that the population grows over time at 2 or 3%, and that's how you get economic growth. If you have a declining population, you're going to have a deceleration of growth. This has been going on in Japan already for a while, right? Yeah. But in the United States, we are going to have the opposite problem.
Well, I guess that's good news for us up here in Canada too, because our immigration levels are at all-time records.
Well, I mean, to your point, like, you guys let in 2% of the country every year legally, and your housing market has gone parabolic. Like, it's really been a function of immigration,
Oh, absolutely. Absolutely. But I guess my concern beyond the current levels of immigration and what's going on in the U.S. as well, whether it's legal or not, is eventually these other countries, you mentioned Italy and Western European countries, they're going to start competing for the same immigrants. And so at some point, maybe the immigrants, particularly the ones with options, will decide to go to Spain or Italy or whatever instead of Canada and America. I don't know, but I wanted to get your take on that, because demographics is what trips me up when I'm trying to reallocate my portfolio and where I'm putting my capital to work. I've just been struggling with that fact, because the birth rate or the fertility rate dropping is just something that gets my paranoia up to a new level. But I like your explanation. I think it's a good one, man. So where can our viewers find you online? Let them know where they can check you out, and tell them about the book a little bit more as well, where they can go pick up a copy.
I'm on Twitter at Daily Dirtnap. You can follow me on Twitter there. I've been pretty quiet on Twitter lately, but I'm still there.
I noticed, yeah.
Yeah, the book is No Worries: How to Live a Stress-Free Financial Life. That's on Amazon. It's also in physical bookstores, so check that out. The new book is coming out in October. It's called Night Moves. That's a short story collection. And if you want to subscribe to my newsletter, it's the Daily Dirtnap. You can go to dailydirtnap.com. If you mention the podcast, I will give you a discount.
I appreciate your time. It's been an absolute pleasure, man.
Thank you. Great talk.